think back to 2018 when we had that near 20% sell-off in the fourth quarter. The low was put in on Christmas Eve, December 24th. So I do consider that. But this variant is interesting. It does have a spike protein mutation that makes it significantly worse than Delta, Beta, Mu, Lambda, and other variants. But in the end, I've felt for a while that this is just a seasonal, mutating, endemic coronavirus. We all have to get the vaccine every year, get a tweaked vaccine like the flu vaccine, and learn to live with it and invest with it.
Yeah. So given that fact, and certainly we've had that conversation on this network for months now, this idea of the pandemic shifting to something more endemic, the reaction we're seeing here in the market is are there buying opportunities here? What would you be looking at? What would you be steering clear of, especially given the fact that there's still a lot of uncertainty and question marks now around how all of this continues to evolve?
The conversation seems to center around drug makers, but, one of the positives is healthcare services. There's virtually no spare capacity in those countries with a, national healthcare system. And as a consequence of that, it does argue that the U.S. would retain its private healthcare system. So that's something to consider. But we've had 5 concerns about the market. I mean, one was the inflation reasons are joined with maybe bubble prevention reasons that the Fed would tighten and maybe tilt more hawkish. We have a tightening of global liquidity from the dollar strength, weakness in cyclical growth by the first quarter, and lagged effect of the tightening that China already did. It works with a lag. Overextension in the stock-to-bond ratio, and I think geopolitics is in its own bull market in terms of risk. So those are 5 good reasons not to be a wild-eyed speculator going into year-end and the beginning of 2022.
Yeah, you don't sound very upbeat looking to the new year when you list those 5 factors that you're watching so closely. What does this do to the Fed tightening timetable? I mean, you see more uncertainty around this variant. You see more potential lockdowns. I mean, whether that happens here in the U.S. or not, we're seeing it in other parts of the world right now, too. You're starting to see, really now, just this morning, dozens of countries, for example, putting holds on travel from southern African countries, for example. What does that do to the Fed's ability to move forward and counter inflation? And I ask that because on the other side of that is if you do see lockdowns in places like, for example, Asia, that's only going to exacerbate supply chain issues as well.
Correct. It's not just monetary policy, though. Remember, it's also fiscal policy. So one of the things the market may be thinking about right now is that this could delay or reduce some of the Build Back Better agenda spending. We need to keep some powder dry in case of contingencies precisely like this. So as you have that uncertainty, that desire perhaps among some of the moderates in the Senate to hold back a little bit, it delays further the fiscal, which is working in conjunction with monetary to provide all this stimulus to the market.
Barry, we have to obviously kind of make a bunch of assumptions as to how this plays to try to decide what it means, for example, for things like inflation. But I do wonder if we should watch the market for signals that it thinks that perhaps there could be supply issues that persist because of this. For example, if you have countries with zero tolerance policies on COVID, and all of a sudden we're talking about, reclosing the factories that started up again and all the rest of it. This idea that inflation has become somewhat disconnected from the underlying growth and consumption story. It's much more of a supply thing.
Yeah, I remember decades ago going to a class with Smith Barney technician, Alan Shaw, and he described how markets tend to move in 3 waves up and 3 waves down. And inflation, including commodities and consumer prices, move in waves. So we've had a big wave, yes, and it was driven by energy, durable and non-durable goods. But next year, inflation may moderate a little bit, but to a higher low. And that's the key, a higher low in terms of the print. And wages occurring before productivity raises unit labor cost. And I'm pretty convinced that rents of all sorts are going to go up in lagged effect to lack of supply and higher home prices. So All this means that the inflation will settle in above the Fed's target. The Fed really does need to move towards away from zero interest rate policy and needs to wrap up this QE fairly quickly.
Shepard Smith here. Thanks for watching CNBC on YouTube.